Investing in equities has proven to be a successful method of investing over a long period of time. Equity income investing is an additional way for investors to maximise their returns from equity markets with an acceptable level of risk. Fund manager Richard Colwell from Threadneedle Investments will talk about the outlook for equity income investing in the UK and how he is constructing his portfolios to take advantage of opportunities in the market. Richard Colwell joined Threadneedle in 2010 as a fund manager in the UK equity income team. He manages a number of Threadneedle funds and, utilising the experience of his team, also co-manages the Threadneedle Equity Income Fund, which features on the Tenet Fund panel. Richard also provides idea generation to the company's other income products. Prior to joining Threadneedle, Richard ran high alpha UK equity portfolios at Aviva Investors. He has also held fund management roles at Credit Suisse and Schroders and worked at the Bank of England. Richard has a degree in banking, insurance and finance and is a member of UK SIP and the Chartered Institute of Bankers. Following this video, advisors should have a better understanding of the current outlook for the UK market, including monetary policy and current debt levels. Have a greater understanding of the outlook for UK equity income, including dividend growth forecasts. Have a better understanding of how Threadneedle approach their UK income strategies. Understand Threadneedle's current views in terms of portfolio positioning, looking at some underlying strategies, and gain an understanding of if and how foreign currency denominated dividend payers can add value to a UK strategy.
What is our outlook for the UK market? I think to start with, it's good to take a step back, to go back to the 08-09 credit crunch and to plot where we've come from before talking about where we're going from here. And I think it's important to remember that the huge imbalances that had been built up are going to take many years to sort of unwind in the West. And as a consequence of that, we've had unprecedented, unusual monetary policy action from governments in the West, most recently with Japan joining the policy of aggressive money printing. And the reason for this unusual policy is to buy time really for the healing process, and in particular for the banking system to sort itself out. Although there's lots of commentary about the various different reasons for monetary policy action and QE, as I say, it's not a solution in its own right, and it's very much about buying time. So in terms of stock markets, we've seen a very strong rally in markets over recent years, and that has been a function of this money printing, which has forced money into risk assets such as equities. I think the case for equities, and particularly UK equities, was strong coming out of the credit crunch, because although these economic imbalances were going to be with us for many years to come, crucially, unlike governments, corporates took the opportunity to sort their balance sheets out and pay down their debt. So we think, it's appropriate that corporates have been able to benefit coming out of the credit crunch from their stronger financial position, and profits have been converted into cash and have improved dividend outlook. And I think it's also important to remember the amount of misery that had been thrown at equity markets, not just at the time of the credit crunch, but I think you can trace it all the way back to coming out of the 99-2000 technology bubble. And really, we've therefore had almost 12 years of a secular bear market. And so the valuations a couple of years ago reflected a lot of bad news. And so I think, you've had a combination of attractive valuations against history and also, I think, against other asset classes, combined with the fuel of liquidity that's come through in the markets in the last few years. So that's the backdrop. In terms of going forward, I think valuations where we are now are not at nosebleed territory. They're more akin to long-term averages. So in terms of the UK equity markets, the median price to earnings ratio is around 16 times, and the spot price to earnings ratio I think is about 12 times, which kind of, as I say, over a kind of 20-30 year period look in line with long-term average. So I don't think that there's any need to panic despite the strong rally we've had, and I think crucially it's supported by continued strong corporate cash flows supporting dividend growth. But I definitely think you've got to mind your eye about chasing strong rallies, particularly when you've had comments from the likes of Bernanke saying he still can't see any irrational exuberance, and the cover of The Economist magazine saying is the bull market back again. So animal spirits I think had got a bit too buoyant coming off the first quarter of 2013, and so it's right that you will see corrections and some profit taking, but I still think that the case for UK equities is strong when you've got the good dividend yield support with the quality of the cover of earnings supporting those dividends much higher than it was prior to the credit crunch. So quite apart from the fact that yield is scarce in other asset classes, I think in standalone terms, UK equities look reasonable value. So what is our outlook for UK income? I think in response to this question, I'd like to deal with two aspects. That as a UK income fund manager who feels very passionately about our product, I think it's important to address a couple of kind of questions or issues that have arisen in recent years. One is that, all you UK income funds own all the same sorts of stocks and it's very concentrated. And two, income funds seem to have done very well. Is it getting into sort of nosebleed territory? Should we be looking at more growth strategies? I think those, to paraphrase, are two of the kind of questions I often get asked by clients. So on behalf of my UK income brethren, trying to respond to that, I suppose I'd say that I think I feel very strongly that the essence of investing and getting decent returns is to get good exposure to well-supported dividend yields, and crucially identifying opportunities where the growth in those dividends from corporates can surprise on the upside. So I think that should be central to any investment thesis. The great thing about coming out of the credit crunch, as I mentioned in the first question, is that corporates very quickly paid down their debt. They didn't want to be beholden to the banks. So with stronger balance sheets, they're much more on the front foot and have been able to redeploy cash that they've generated back to shareholders, as well as invest back in their business. So we've seen not just a dead cat bounce in dividend growth coming off of the credit crunch, but a sustained nice continuation of dividend growth across the market. And I think for the current calendar year, we're expecting that kind of mid-single-digit dividend growth for the market at large. So the quality of the dividend cover is good. So I think the attraction of UK income remains strong. And I think there's been very successful growth in global income funds, and that's understandable. That gives you diversification away from the UK equity market, some industries that perhaps you have less exposure to in the UK market. However, I'd go back to saying that UK income is very attractive because sort of 75% of profits in the UK stock market come from overseas, so we're very much less landlocked than perhaps we were in previous recessions. You're less beholden to just purely domestically generated profits, so you get great diversification, I would argue, from UK income strategies anyway. And also you've got the heritage that corporates that are listed in the UK have that discipline of dividend paying, which is something that's only more recently been adopted in overseas markets. And continuation of the balloon debate, I guess, is that if you look at the yield on the UK market, even after the strong rally over the last few years, it's still over 3, which obviously compares favourably against other overseas equity markets, as well as the gilt market, and even now the crossover you've had with corporate bond yields. So I think you can still make a strong case for UK income. And the performance track record of the aggregate UK income universe compared to UK growth funds stacks up very favourably. And it's not just about being sort of bear market junkies and trying to preserve capital in a down market. You would expect income strategies to be more defensive and more resilient and give you that sort of characteristic. But you've also seen very good total returns from UK income strategies in recent years. So, it's continually don't get sort of rest on your laurels. You've got to be wary of individual corporates who might be over distributing and making poor capital allocation decisions. But in general, we think there's still further scope for positive surprises with dividend growth. And also, it's an interesting feature that whereas in the US, say, corporates seem to be more incentivized to distribute monies back to shareholders by way of buybacks. And when they're doing that, when the rating of US equities has got quite a bit higher than they are in the UK, you have to question what kind of returns they're generating from that decision. Whereas in the UK, I think it's encouraging where corporates have enjoyed strong share price rises that in addition to their ordinary dividend paying, that they've also selectively decided to give monies back to shareholders by way of special dividends from their day-to-day operations. And that's in a wide range of different industries, whether it's Wolseley, the plumbing distributor, ITV, Johnson Matthey. These companies have supplemented their attractive dividend growth with specials as well. And I think that could be a feature going forward, which I think benefits UK income. What are the differentiators in approach so that UK income strategies are not all simply chasing the same opportunities? With this question, I think it's worth sort of taking a step back and sort of challenging, I think, a bit of a perception that income guys just simply get out the FT and buy the stocks with the biggest yields in the market. There's a heck of a lot more to it than that, and there's lots of different strategies that you can deploy. Personally, I think we like to generate a portfolio which gives an attractive yield rather than sticking to sort of a rigid screen on individual stocks. So in other words, within the portfolio, we're trying to generate an attractive total return within which the yield and the growth of the dividends is a crucial part. But that allows us to buy recovery situations early before they get back on the dividend roster. And likewise, selectively, we might, at the other end of the spectrum, buy more growth-orientated companies if we think the prospects of dividend growth are not factored into the current share price. So, as I say, it's building the yield at the portfolio level, not at the individual stock level. Other income managers take this one step further and have more of an explicit barbell approach, where they may hold more aggressive positions on high conviction, bigger yielding stocks, which gives them, if you like, the ammunition to sort of have greater exposure at the other end of the spectrum of smaller to lower mid-cap stocks, sort of where the yield is less than the market, but blended together gives an attractive yield at the portfolio level. You might also have seen some UK income funds coming out of the credit crunch and with concern of potential concentration, have decided to take more of a sort of broader church approach, and have actually introduced quite a number of holdings from overseas listed markets as part of a thematic approach. So in other words, if you've got high conviction that pharmaceutical as an industry has suffered a huge derating and is now attractively valued with more resilience in the cash flows and therefore safety in the dividends than the market appreciates, whilst you're not paying much for any potential new products in the pipeline, then rather than be beholden to the two UK listed big pharma stocks, some UK income guys have also decided to buy and augment those positions with overseas listed pharmaceutical stocks as well. So, there's sort of thematic approach, there's a barbell approach, there's the total return approach, and then there could well be some income funds that decide to differentiate themselves within a very competitive space by focusing on what they see as their core strengths of hunting for exclusively mid and small cap stocks with decent yields. And then I've seen also other strategies where people have been more disciplined and just sort of look for only stocks if they've got a certain threshold of yield. I say personally, it's horses for courses, but I would find those two strategies too inflexible. And I personally think there's enough opportunities in the UK market, given that you've got great exposure to some world-class franchises, that I don't need to go hunting in overseas markets. But as I say, I think there are lots of different opportunities, and within a very competitive space, I think there are lots of different ways in which some of the lead managers have generated good total returns for their clients over a number of years. So, I think, it's important to go beyond just the list of the 5 biggest individual stocks in a fund, for which there may be a fair degree of commonality. And actually, just because whatever it is, 40% of the quantum of income in the UK market is generated from a relatively small number of mega cap stocks, it doesn't mean that we're all constrained by that. Actually, there's lots of good opportunities. And as I say, in my case, I've really benefited from buying early some stocks before they come back onto the dividend roster when they're still on the naughty step, and you can augment that with current attractive paying yielders at the same time. So, there's good opportunities within the UK income space, and because it's so competitive, in a sense that sets the bar that much higher, and the accountability that the track record of the funds in that area, you can see in terms of the risk adjusted returns that funds have generated, whereas arguably global income funds is by definition a newer area of the market, and the track record is obviously by definition shorter. So there's pros and cons. So what do I think is the best way to currently position a UK income portfolio? And obviously the short flippant answer is the way my current portfolio is. But the more instructive response to that is trying to bring forward some of the themes from the previous questions. and that's to say that you do not want to get sort of caught out trying to chase market rallies and ricochets off market falls. Trying to sort of market time, I think, is a mug's game, and you want to set out your portfolio with a more balanced approach, but with good conviction in the stocks where you think you've got an angle that the market's not fully appreciated. And so, coming out of the credit crunch, although I think there's quite a lot of gloom about the extent of the imbalances and how long it'll take to sort them out, we thought it inappropriate to have the same sort of portfolio structure as we had in 2008 going into the credit crunch, crucially because of this earlier point about the strength of corporates' balance sheets. So the way we've structured our portfolio over the last sort of 3 or 4 years has been pretty consistent, really, and has not been at the behest of trying to call market timing. So in other words, we've got a bedrock really of stocks which, if you like, we would characterise as cash flow compounders. So decent high return businesses with a high degree of self-determination that they can fund their own investments, and in a world of relatively low GDP growth, we thought these sorts of companies, whether it was the Unilevers, Compass, Reed Elsevier's, ought to be able to re-rate and command a premium against the wider market because of that degree of resilience. And you were able to buy those sorts of stocks coming out of the credit crunch on attractive yields. From here, some of those stocks, we're very pleased to say, have re-rated strongly, and there has been some debate in the market about whether has this gone too far? Is this similar to the Nifty 50 that built up in the US market in the late 60s, early 70s, where a select number of stocks with similar attributes got to, sort of something like 40 times PE. And I clearly don't think we've got that stretched at all. We're not in new paradigm territory, and against a median market valuation of about 16 times, I think in the select case of the stocks of that nature that we do own in our portfolio, that the valuation is not overly stretched. However, it's not the first port of call for new money inflows into the funds. Instead, it's more stocks that have perhaps similar attributes in terms of cash generation, but have operational difficulties, and as a consequence, the shares have lagged the wider market. So, you can think of things like Morrison's Supermarkets, Imperial Tobacco, even Pearson, the media company that was a stock market darling only 18 months ago. Because of some short-term trading issues, the shares have come back into very attractive valuation territory. So that's the sort of bedrock of the portfolio. But because, as I say, balance sheets are strong, we thought coming out of the credit crunch that it was also appropriate to have good exposure within the portfolio to what I might call contrarian cyclicals, i.e. stocks which might not necessarily ordinarily been associated with an income fund, which are more economically sensitive, so more volatile stream of cash flows supporting dividends. But crucially, if you can get in at distressed valuations, which you were being offered 4 years ago, then those sorts of stocks, particularly when they've got sort of structural drivers, so things like GKN, Electrocomponents, some of the media companies like ITV. So, these stocks have been very strong performers, and you want to be on the lookout continually for similar sorts of stocks. So you don't buy Woolsey today because the US housing market has recovered, but 3 or 4 years ago the valuation gave you a great cushion to buy into a stock well before it had got back to the kind of long-term average profit margins. So it's trying to job against the tide really, and not wait for the kind of classic macro weather forecasting, because by then it'd be too late. I suppose an obvious example, high profile of recent months has been Marks and Spencer's, which is never out of the front page of the news. Everybody's got a view on the clothes there, but by the time they've sorted it out, it'll be too late. And already the shares have started to rally over the last 6 months or so. And that's a stock that, we were looking to buy a year, even longer ago, because you were paid to wait, an attractive starting yield. So, when you get the comment, what's the catalyst? It's valuation. It's not waiting for the news flow. So there's lots of opportunities, even with the market having rallied a fair way in recent years. As I say, there's always some laggards where interesting valuation discrepancies are thrown up. So, back end of last year, everybody was very fearful about the consequences of the US defence budget and whether there'd be quite a draconian cut in one go rather than over a sustained 10-year period. And companies like British Aerospace were very cheaply valued as though their cash flows were under much more threat than the reality. So, you can buy in on those sorts of stocks when they're on very distressed yield situations where if you've done the work, you can see that, they're much more resilient than that. And so pleased with the subsequent re-rating of that share in the last 6 months. But you're always on the lookout for similar situations. But the general shape of the portfolio has not massively changed in the last 3 or 4 years, that you've got that combination of the bedrock cash flow compounders with select contrarian cyclicals. And you don't chase the cyclicals when the market's on a high, but when the madding crowds get fearful and sell down the market, then you can be afforded some great opportunities to revisit situations like that. So a main message takeaway is that avoid this unhealthy obsession with benchmarking, not just against the index, but also your peer group. So some income funds have very, very big positions in, Vodafone or HSBC. It doesn't mean to say that you have to own those stocks. The crucial thing is to be on the front foot and have conviction in the stocks where you think you've got an angle. So if you've got enough BT at the lower levels from a few years ago, or Unilever, as I mentioned earlier, and maybe Marks and Spencer's now, then that gives you opportunity to add alpha for clients. So why have there been some high-profile dividend cuts recently, and how will this affect stock selection strategy? In terms of the why of the dividends cut, I suppose it is interesting that obviously balance sheets needed to be sorted out after the bone cruncher of 08-09, and so you saw widespread dividend cuts and refinancing of balance sheets. So I suppose the obvious thing is that if now 3 years, 4 years on from that, why are there a few companies who are still now feeling the need to redress balance sheet strength and cutting dividends, and in some cases needing fundraising, and that's why those sorts of stocks have been probably punished more than you might have expected, because rather than in with the pack, it's sort of they've done it too late. They should have sorted themselves out with hindsight a few years ago. But it's very much case by case and the reason for a dividend cut, and it's a decision made at the board level, not lightly given the culture in the UK of upward ratcheting of dividends. So that a stock will be punished, and it's sort of partly a credibility issue, but also a signal for the strength of the business going forward. But what you don't want is companies making the wrong capital allocation decision, and you don't want a business starving itself of internal investment in the business just to prop up the shares by over-distributing a dividend. So, I think it's wrong to mechanically say as soon as a stock in my portfolio has a dividend cut, or that I immediately sell it. The reason why you own a share should not just be purely for its dividend yield. You should hope that you've identified valuation upside in terms of capital growth opportunities. So I suppose one of the most high-profile recent example is Royal Sun Alliance, RSA, which I own a decent slug of in our income portfolios, and I was surprised that they took the decision to reduce their dividends in the first quarter of 2013. However, the reason why I primarily owned RSA and continue to do so is, I think, in particular, the valuation credited to its Scandinavian and Canada businesses is not fully reflective of the true value and particularly the returns they're generating on those businesses. So the management have made a decision that they thought it was a more appropriate capital allocation to reduce the dividend so that they had more scope to invest internally in the business in those sort of growth areas. And if you like, well, having done careful analysis and met the management subsequent to that decision, we're going to back them, and we've bought more shares. So it's case by case, and you shouldn't just mechanically own a stock purely for a yield. But it's the nature of portfolio construction, and that for income strategies you will be looking at situations with higher yields than the market average, and by definition that means that the market might be fearful of the sustainability of those dividends. So if you're right and you buy BT at 80p or you buy ITV at 50p, you're handsomely rewarded by strong growth in the dividends and capital appreciation in the share price. But it's about portfolio construction and doing enough work to understand the levers to how you can get the shares higher. And as I say, in the case of RSA, I still think it's a very attractive share despite the dividend cut. There are other situations more recently, I think First Group, the bus and rail operator, where the balance sheets clearly got out of line and they needed a rescue fundraising, and so the dividend was obviously removed. But there's still a debate as to whether they've raised enough money given their ongoing capex requirements. So you've got to do the analysis on sort of fallen angel recovery situations as to decide whether you think the valuation more than factors in a fundraising. We did the work and thought it didn't, so in that case pleased to have avoided that situation, but it's case by case. So is there an opportunity in foreign currency denominated dividend payers as a result of sterling weakness? Well, obviously sterling over the kind of 5 years has depreciated against the dollar, I think about 25%. And from memory, I think about 40% of dividends in the UK market are dollar denominated, which, so it's been nice sort of flexibility of corporates in the UK, that if they're paying dividends in dollar, then it gives them a bit more flexibility, and there's upsides to the distribution. So thinking of companies like AstraZeneca, which pay in dollars, given that the operationally there's headwinds in terms of managing patent expiries, the fact that they've committed to maintaining the dividend, which is very attractive. The sort of the dollar strength against sterling, I think, at the margin will have helped. But do you construct a strategy at the portfolio level based around trying to exploit the fact that you think sterling's going to remain weak against the dollar? I think it's pretty marginal. I think it's a nice to have on top of your core reason for owning a stock, maybe, rather than a central case. So I think there's a danger of overly focusing on currency as a strategy within your income portfolio. But I think you've got to be very aware of the extent to which, as I mentioned at one of the earlier questions, I think it's about over 70% of earnings, profits generated by UK listed stocks come from overseas. And as I say, if you've got that quantum of about 40% of dividends paid in dollars, then at the margin it helps. It helps add to the attraction of UK income as a sterling denominated strategy, that you've got that benefit. So whether you believe that sterling can depreciate still further, I guess if QE does get tapered in the US, then you ought to see the dollar rise still further. But we're not currency specialists running income funds, and I think, as I say, I think you don't want to be too beholden to that strategy. It's good to just be pretty plain vanilla, and where is your edge? It's identifying valuation at the stock level within reasonable valuation parameters, rather than trying to second guess currency moves.
We hope you now have a better understanding of the current outlook for the UK market, including monetary policy and current debt levels, of the outlook for UK equity income, including dividend growth forecasts, of how Threadneedle approach their UK income strategies, including their current views of portfolio positioning, and finally of if and how foreign currency denominated dividend payers can add value to a UK strategy. We hope that you found this session useful. Thanks for watching.